today we have our November webinar. It is titled Death is Certain, but Some Taxes Are Avoidable. And our lovely attorney, John Donnell, will be presenting over this. John, why don't you take it away?
Thank you, Allie. My name is, as Allie introduced, is John Donnell. I'm the senior attorney at Generations Law Group and the head of its tax and trust department. And as Allie mentioned, our webinar topic for this month is taxes, and in particular, the fact that even though death is certain, some taxes, not all, but some taxes are avoidable. Now, this presentation is meant to be a general overview of estate planning and should not be considered as legal advice. You should consult an attorney in your state to determine the legal requirements for your individual situation. Next slide, please. So, is the old saying that there are only two things certain in life, that is death and taxes, necessarily so? Certainly death is yes, but taxes also, maybe not. With proper tax planning, the only thing uncertain is life, maybe just death. Now, when we think about taxes, we can tend to group them into three broad categories. Taxes on what we earn, taxes on what we buy, and taxes on what we own. And within these groups, there are many specific types that we'll take a look at now in the next slide. Here's a breakdown of the major types of taxes that we may encounter: day to day, week to week, month to month, year to year. First is the taxes on what we earn. These are based on our income or our earnings. The first bullet is the one that we're all quite familiar with, that we have to pay annually, if not quarterly, but file a return annually at tax time in April, is the individual income tax. We pay taxes on our wages, salaries, interest, and dividends. Corporations too have to pay an income tax. They pay a tax on their profits called a corporate income tax. Something that many of us are familiar with as well, if we've ever worked for an employer or been self-employed, we have the payroll tax, which includes both Social Security taxes and Medicare taxes. This is to help fund the Social Security and Medicare system. If you work for an employer, these are split between the employer and your employee, each paying half. And if you're a self-employed person, you get to pay the whole thing, but you also get a deduction for half of that on your income tax return. And the last type of tax within what we are taxed on and what we earn is capital gains tax. And this applies to profits from the sale of investments like stocks or other properties. For example, you buy a stock or mutual fund at a certain price, you hold it long enough for it to appreciate, and then you sell it. The gain on the sale is going to be subject to the capital gains tax at rates that are more favorable than the rates that apply to our wages and salaries. Next category is taxes on what we buy. We face these day to day or week to week. At least in Massachusetts, the sales tax, which is added to the price of goods and services at the point of sale. Some states, like our neighbor to the north, New Hampshire, doesn't have a sales tax. You often see, you haven't yourself, go up to New Hampshire and get a big thing, sales tax free. They have no sales tax, but they do have other taxes in the form of, for example, meals tax. You go up there, and I think they have a meals tax, I should say, for sure, a tax on lodging, which we have as well here. Our sales tax is at a rate of 6.25% on purchases, so pretty high. There's also the excise tax applied to specific goods. This is both a federal and state tax applied to certain kinds of things, such as gasoline, alcohol, and tobacco. Then we have the category of taxes on what we own. This relates to our property and our wealth. Those of us who are homeowners are familiar with the first bullet point, the property tax. There are real estate taxes on real estate we own, which is paid quarterly in most towns, but in some towns semi-annually. We also have the estate tax, which is charged to a decedent's estate on the transfer of wealth at death. This is the one we're going to spend most of our time on today. In addition, we have a gift tax, this time not a transfer on wealth at death, but a transfer on wealth during lifetime. And lastly, in only a very small spattering of states, is there an inheritance tax, which is paid by heirs on what they've received from someone who's died. Lastly, at the bottom there's other kinds of charges that are tax-like or really are taxes in the sense that they do raise revenue and do force us to pay more for things. One of them is tariffs, which is in the news all the time lately, and fees and tolls for the use of things like the use of the roads. You pay a road toll, or you buy your Easy Pass to pay for it that way. Next slide. So as we can see, there's lots of ways for the government to impose taxes on us for all kinds of things, which then leads to a question, which are there ways to avoid or minimize this tax burden or make it go away entirely? Two of the more burdensome taxes to those with at least moderate wealth are the individual income tax, including the capital gains tax, and the estate tax. At the federal level, most of us are not concerned with the estate tax at death due to the very high federal threshold of $15 million in this coming year. But all of us, to a greater or lesser extent, are subjected to a federal income tax every year. But what about at the state level? The state level, here in Massachusetts, many of us are subjected to both an income tax during lifetime and to an estate tax at death due to the very low thresholds for exposure to both of those taxes. For example, or specifically for income taxes in Massachusetts, as soon as you reach $8,000 of taxable income, you're exposed to an income tax at rates of 5% or 8.5%, depending upon what the income is. And in any year that you might have sold something that is highly appreciated, like your home, and if you cross the $1 million threshold of income in that year you sold this highly appreciated asset, such as your home, you can have an additional surtax on top of the 5% for a total of 9% on that income over $1 million. In Massachusetts, we also have a tax at death, the estate tax, at rates that run from 8% to 16% on your wealth to the extent it exceeds currently $2 million. And there's going to be more on that later. So with income taxes as high as 9% during life and an estate tax as high as 16% at death, this raises, I think, a reasonable question for all of us here in Massachusetts is what are our options for minimizing this exposure, or even better would be how do we avoid it entirely? Next slide. Well, one way is we can move out of Massachusetts. In moving to a state that doesn't have an income tax or an estate tax can avoid state taxation of your income and wealth entirely. But let's take a look at what these states are. The first we're seeing on the slide here is the states that if you die in them, you can be subject to an estate tax at death on your wealth. There are 12 and the District of Columbia that impose an estate tax at death. And you can see to the right of the state, the exemption level, which when you cross that threshold, your estate when you die would be subjected to an estate tax. And you can see us here in Massachusetts, this is alphabetical in the middle there, but with a $2 million exemption, one of the lowest thresholds for becoming exposed to the estate tax at only $2 million. So when you look at this list, then by process of subtraction, there are 38 states you could live in and not have an estate tax on your wealth at all at death. You might well achieve the same outcome if you moved to one of the states on the list that have a much higher threshold for estate tax exposure than Massachusetts does, such as close to us, Maine or New York. Next slide. What about state taxation of our income? What states might you live in with none of your income being subjected to an income tax? Well, we count 9 in this country, and they're listed there, I think in random order. If we look at some of them, Alaska, no income tax, and you get something called an annual oil revenue dividend. I think if you're producing oil, I have no idea. I'd have to live there to know, I think. Florida, very popular in this neck of the woods for the so-called snowbirds who want to go to a warmer climate. There's no income tax there. Nevada, no income tax, relying heavily on tourism and gaming revenue. And then we have some states like South Dakota and Tennessee that don't tax your income, relying on very, very high sales taxes for them to raise revenue. And then you have states like Texas and New Hampshire who don't tax your income, but gain revenue from relatively high real estate taxes, property taxes on your real estate. So you can see from the list, for many of these states to make up for the lost revenue for not having an income tax, you're paying high sales taxes like Tennessee and Florida, or property taxes like New Hampshire and Texas. So your overall tax burden by moving to these states can certainly vary. But if we put these two lists we've just looked at together, then we can come up with what states that we could live in where we can successfully avoid state income tax during life and not have our wealth subject to an estate tax at death. On the next slide, we'll see these states, there are 8. And most prominently, the 2 on the top, Florida and New Hampshire, are the ones that we see many former residents of Massachusetts, in fact, moving to. One, New Hampshire, because it's nearby, and you can still take advantages of the local healthcare, the very good healthcare you can get in Boston area by just moving to New Hampshire. Florida, you'd move there typically because you like warmer weather and escape, again, both income tax and estate tax at death. Also on the list is Alaska, but you have to ask yourself, do you really want to make that move to escape taxes? Maybe you do. I certainly don't. Next slide. So for many of us, we're not going to move. And reasons for that may be, most often is because our family's here. You know, we have our children, we have our grandchildren here. And so we want to stay here. Or, you know, and or really, I think it's an and. We know the quality of the healthcare here. We like that. We have our doctors, we have our hospitals here, and we want to take advantage of those services. So here we are, so to speak, stuck in Massachusetts. And in that event, are there still ways to minimize or even avoid the Massachusetts income tax and or estate tax? And I can say with proper planning, the answer is yes. And for today's program, we're going to focus entirely on the Massachusetts estate tax, maybe leaving for another day what you can do to deal with the Massachusetts income tax. But today, we'll talk about the Massachusetts estate tax, and in particular, some techniques for minimizing, if not eliminating, its impact on your family after you die domiciled here. But before we get into these techniques, we need to understand a little bit more about what an estate tax is and how Massachusetts goes about taxing your wealth at death. So an estate tax is a tax imposed on wealth at a person's death. Call this person the decedent, typically legal lingo. We call the person a decedent, someone who's died, and that person is passing or transferring from themselves to their heirs, family members, their wealth. The U.S. Constitution does not allow for a wealth tax on stationary wealth. But the Supreme Court in the early part of last century ruled that if that wealth moves, then it is fair game to be taxed. Hence the moniker transfer tax, under which larger heading falls the gift tax for transfers during life and the estate tax for transfers at death. Federally, we have both of these taxes, a federal gift tax, a federal estate tax, but thankfully, due to very, very high threshold for exposure to them next year of $15 million, most of us, meaning 98% or more of us, are not concerned with a federal gift tax or a federal estate tax. However, those of us in Massachusetts are concerned, at least with regards to the Massachusetts estate tax. Now, some good news is we don't have a gift tax. So having a tax on wealth at death, but no tax on wealth during life, creates a planning opportunity we'll touch on in a few moments, which is simply if you're going to be taxed on that wealth at death, but you wouldn't be taxed on that wealth if you gave it away during life, then there's an opportunity to give it away while you're living. And we'll talk about how to go about doing that in a few minutes. Now, in Massachusetts, the basis upon Massachusetts government being able to tax your wealth at death is that you have to die domiciled here. Not just that you happen to die here, God forbid, if there's an accident in Massachusetts. No, you have to be domiciled in Massachusetts in order for the state to have the jurisdiction to tax you. Or if you don't live here, but you own real estate here, that's a way for them to get you with a Massachusetts estate tax as well, if you have real estate located in Massachusetts. Now, the threshold for exposure to Mass estate tax for decades was only $1 million, making us in Oregon, if we looked back at the, and actually I was corrected once by a good friend of mine who lives out in Oregon to say, it's not Oregon, John, it's Oregon. So I just did it again. I say Oregon, but it's Oregon. Us in Oregon were the states with the lowest threshold in the nation. Worst yet was that in Massachusetts, once a decedent's gross estate crosses the threshold, the estate tax was imposed on every dollar of assets making up the decedent's gross estate all the way back to dollar number one, not just the amount over the threshold, which therefore was often referred to as a cliff effect, meaning that once you cross the threshold, you in effect fall off the cliff to the very bottom with every dollar of your asset from dollar number one being subjected to estate tax. Now, the estate of a decedent dying domiciled in Massachusetts with a gross estate in excess of the exemption threshold has to file a Massachusetts estate tax return called an M as in Michael or as in Massachusetts, an M706 to report the decedent's assets, take any available deductions, and pay a tax on any net amount over the applicable exemption amount. Which then raises another question, which is, what of my assets are going to be subjected to this estate tax? And unfortunately, the answer is nearly all of your assets are going to be assets leading towards this threshold for exposure to the estate tax. Even the ones you wouldn't think of, like life insurance that you know is not subject to income tax, or most of us know it's not subject to income tax on your beneficiaries when you die. Retirement savings, until we take the money out of retirement, we know we're not being taxed on it. Nevertheless, at death, the entire retirement holdings are subjected to the estate tax. So retirement savings, the 401ks, IRAs, life insurance proceeds, as well as your home in Massachusetts, your bank and investment accounts, even if they're jointly owned with others, annuities you might have, a pension, if it continues to pay to somebody after your death, that will be taxed. An automobile, your household effects, jewelry, collections, as you can see, practically just about everything you can think of. But there is one category, importantly, that would not be subjected to Massachusetts estate tax because they don't have the jurisdiction to tax it, and that is if you own real estate outside of Massachusetts. Real estate outside the borders of Massachusetts is not subject to Massachusetts estate taxation, but there's always often a but when it comes to taxes, I think. But the Massachusetts Department of Revenue's current position is that you still count it towards trying to determine whether you're over the exemption for filing purposes, for whether you have to file a return. So not subject to estate tax, but in trying to figure out whether you have to file a return, meaning if you're over the exemption, you have to file a return. It is counted. An simple example is you have a home and savings in Massachusetts of $1.8 million. You have a condo in New Hampshire worth $500,000. Just looking at that, you're going to know, based if you're listening to me so far, you're not going to be subject to estate tax because Massachusetts can't tax the out-of-state real estate and the other assets you own are under $2 million. However, the Department of Revenue, our taxing authority, says you still have to file a return because when you add the out-of-state real estate to what you have, other assets that you have, you're 2.3 million in my example, and therefore you still have to file. And then what you do when you file is you subtract out the out-of-state real estate to show the government that you're under 2 million. Seems ridiculous? You can say it is ridiculous, but it is what the Department of Revenue's current position is, and all we can do is hope that they'll change their position, or if not change their position, Congress in Massachusetts through legislation might change it for us. Now, once you're over the Massachusetts exemption and have to file, there are certain deductions that you can take to reduce your estate tax burden or get you back under the exemption so you don't have estate tax at all. The biggest of those deductions is called the marital deduction, meaning if you are married, there is a dollar for dollar deduction for every dollar you leave your surviving spouse. Unless, again, here's the but, unless your surviving spouse is not a United States citizen, that rule doesn't apply. This means for most married couples, there'd be no estate tax due when the first spouse dies, because most the first spouse to die of a married couple are likely to leave most, if not all, the assets to the surviving spouse, so there would be no estate tax owed. Again, that doesn't mean you necessarily don't have to file, because again, the measure of whether you have to file is all of your assets totaled, even those that are going to your spouse. You file the return, and then you deduct those assets going to your surviving spouse to end up with no estate tax, but you still have to file if you're over the Massachusetts exemption threshold. Other deductions real quickly are debts. If you have a mortgage or a car loan when you die, that gets subtracted from your gross assets. You can get a deduction for your funeral after you're deceased, as well as expenses of administering your estate, lawyers' fees, court costs, and appraisals, things you have to pay after death to administer your estate. Those are deductions too. Now, in 2023, Massachusetts finally, after 2 decades, doubled its estate tax exemption from $1 million to $2 million per person. This means now that estates valued below this threshold are no longer subject to estate tax and in many cases don't have to file a return. In the past, you could imagine you'd easily get over $1 million with a house in Massachusetts and some modest savings. Now, many estates will not have to be subjected to the estate tax. As importantly, is the new law in 2023, in addition to increasing the exemption amount to 2 million, also eliminated the so-called cliff effect that I mentioned earlier. That is, once you cross the threshold and are subject to the estate tax, now you're only subject to estate tax on the amounts above $2 million, not all of your estate all the way back to dollar number one, which is the way the law used to read. Next slide. So with these improvements, I think for some people, some couples and individuals, there may be no need to worry now about the Massachusetts estate tax. However, I think it still matters to a lot of us for the bullets that you see here. Home values, they add up quickly. And when you have savings for retirement, in addition to a valuable home, you're quickly looking at $2 million in many cases. Also, there's something that we don't have in Massachusetts that you have at the federal level, which is called portability between spouses. This simply means, as I said, it's a $2 million exemption for each person. So if you're married, husband has a $2 million exemption, wife has a $2 million exemption. But when husband dies, wife doesn't automatically inherit or gain his 2 million exemption so that she'd have 4 million on the marital assets. Husband actually has to do something to make that happen. And that's one of our planning opportunities we're going to look at in just a minute. And the last bullet there, the exemption isn't automatic. You need to do some planning and you need to have your assets arranged in a certain fashion in order to get the use, particularly in this case, of both a husband and wife's exemption, and even your own as a single person. There are steps you need to take to make sure you're getting the most of that exemption. So next slide. We can finally look at what our estate planning strategies in Massachusetts are for minimizing exposure to the estate tax, or in some cases, avoiding it entirely. Now, the first bullet there on the list, the credit shelter trust or bypass trust. As I mentioned, there's not this thing called portability between spouses, which simply means, in my example, when husband dies, wife doesn't gain husband's 2 million exemption and get 4 million when she dies, even though she gets all the assets. She's left with all the assets appropriately, but is also left with only a $2 million exemption to apply against all of the assets, which might then lead to exposure to estate tax. With some proper planning, we can make sure the husband uses some, and in the best case scenario, all of his exemption when he dies. So we can double up. So we can get both husband's 2 million applied against the assets and wife's 2 million applied against the assets. It's trust planning. It involves what we call credit shelter trust, as you see there, or bypass trust. Bypass trust meaning surviving spouse can still gain the benefit of the marital estate, both husband and wife's assets, after husband is gone, in a trust that will not subject the assets of husband to wife's estate tax when she dies. For today's purposes, I'm not going to say a whole lot more than that because it'll start getting complicated or confusing. The important point is it's a strategy that you can use by consulting with your estate planning attorney. The next bullet, maybe with your estate planning attorney, but maybe even yourself, lifetime gifting. We talked about earlier. Massachusetts has an estate tax, but it doesn't have a gift tax. Saying it a different way. Massachusetts has a tax on the transfer of your wealth when you die, but not on the transfer of your wealth during life, meaning gifts that you make during your lifetime. So you can give unlimited amounts during your lifetime to family, children, grandchildren, more distant relatives, even in-laws, and reduce your estate tax burden by reducing what you have left over at death to pass to family. You can imagine a scenario where a single person might have $2.3 million. And if that person dies owning that 2.3 million, they're over the $2 million threshold. Some of it will be exposed to estate tax. On the other hand, if before that person dies, that person makes gifts totaling in excess of $300,000 to family, then they will pass away with less than 2 million, and there'll be no estate tax and no tax on the transfer of that wealth during lifetime because we don't have a gift tax. We don't have a tax on transfer of wealth during life. So that is a very effective means of minimizing the estate tax burden at death. However, with that being said, there are certain assets that are better candidates than others for making gifts. Real quickly, assets that have appreciated greatly during your lifetime may not be well suited to you gifting those away to your children. For more on that, stay tuned for a future webinar or blog, and we'll give you more details. But suffice to say, not all assets. Consult with your tax advisor or attorney on the lifetime gifting, at least to figure out which ones are appropriate, which ones are not. Charitable planning. Dollar for dollar, every asset you give to charity is deductible, meaning, again, in our example, if this single individual has $2.3 million and wants to leave 400,000 of that to charity at death and the balance to family, there'll be no estate tax. That $400,000 bequest to charity after death will have a deduction that will pull them under 2 million in terms of the estate tax exposure, and there'd be no estate tax owed. Finally, very importantly, is to review from time to time with your advisors, your estate planning attorney, your financial advisors, how your assets are titled. Because the best planning you might be doing might get undone by inadvertently having your assets titled in a way to not save the estate taxes that you're trying to achieve savings with. Next slide. So, all this said, even with a higher exemption, many Massachusetts families will still benefit from thoughtful estate tax planning if your total assets, including real estate, IRAs, 401ks, savings in the bank, exceed 2 million or even are approaching that number. Now would be a good time to review your estate plan. And our experienced attorneys at Generations Law Group can help evaluate your options, take advantage of the new rules, and design a plan that protects your loved ones and preserves your legacy. Next slide. I want to thank you all who are out there for joining me today for this webinar. And if there are any questions, you can certainly contact us at the phone number there or by email, and I'd be happy to answer any questions you have based upon today's webinar content. Thank you.
Thank you very much, John. That was a wonderful presentation. Thank you, everyone, for joining, and have a wonderful day.